Hi, my name's Mike Ford and I'm with Coast Commercial Credit. I'm here to talk to you about new investor car wash financing. A little bit of background on Coast Commercial Credit. I've been financing car washes for over 30 years, started in 1988. And Coast Commercial Credit specializes in financing for new investors as well as existing operators. Today we're going to talk a little bit about the types of financing that are available for new investors and give you some tips on what to look for and questions to ask. The first type of financing that we're going to talk about is seller carry or owner carry. And that means if you're out there and you're looking to acquire an existing site, the current operator may decide to carry a note, and that means they're going to offer financing to you. You put down a certain amount of money and they'll carry the rest. So you buy a wash for $3 million, you give them $600, they finance the other $2.4 million. The advantages of seller carry are that it's generally the quickest to market, the lowest cost, and you're able to negotiate terms. That's probably the easiest way to get into the car wash market, but there are challenges involved with seller carry or owner carry. Those include possible contamination, so you want to make sure that you have reports done, like a Phase 1 environmental report, and also current liens. So you want to make sure that you use a title company, a real estate attorney to be able to secure that transaction. We're going to focus primarily here on three other types of financing. Financing through the Small Business Administration or the SBA, conventional financing, and USDA financing. First of all, the SBA has two different types of loan programs. The first type is the SBA 7A loan program. The 7A loan program is a loan program where you can get in for as little as 10% down, typically between 10 and 20% down. The term on that program is 25 years. Rates can be fixed or variable. So generally they're prime plus a spread. The maximum spread on an SBA 7A loan is 2 3/4. The current rate for that would be 6%. Prime rate is currently at 3.25%, so 3.25 plus 2.75 equals 6. Generally, if you're financially solid, there are other options available. For example, we offer a fixed rate SBA 7A loan, generally priced around prime plus 2, so 5.25%. Things that you need to know about the SBA 7A program. It's generally all-inclusive. And what I mean by that is land, building equipment. Those are the basic building blocks. But there's also things like working capital, inventory, contingency, soft costs, permits, architecture, engineering. So what is working capital? We all know what land, building, equipment are, but what's working capital? Working capital is money for you when you open your doors. So in an SBA 7A loan, you can include working capital. The typical amount of working capital that's in an SBA 7A loan for a car wash would be $50,000 to $100,000. Inventory, we typically see inventory ranging from about $5,000 to $20,000 in our loan request. So those items can be included. Now, other things that I'd mentioned, contingency. What is contingency? Well, contingency is funds that are set aside for you to use in the event that there are change orders during your construction. Let's say you have a $1.5 million construction. We'll put in a 10% contingency, or $150,000. Now that's kept separate from the actual construction contract. We want you to control that money. And the reason why you want to control that money is because if you put it in the construction contract, the contractor is going to use it. So you want to keep those funds separate. And those are for change orders. And virtually in almost all of our construction projects, we're seeing that there's change orders, some or all of the contingencies used. Soft costs that are also included in an SBA 7A loan may include the permits, the architecture, the engineering, impact fees, traffic studies, things of that nature, city fees that may be charged. So basically, in an SBA 7A loan, it's an all-inclusive loan. It includes all of those variables, and that would be a key point for you to understand. If you're looking for a loan, you want to ask your banker, hey, what's not included. And what's not included, if you find out that equipment or working capital or inventory or contingency are not included, then of course that's going to affect the amount that you have to put down. The general rates right now for an SBA 7A loan are running between 5 and 6%. I'm going to go forward and talk a little bit more about another SBA loan program, and that's the SBA 504 loan. The SBA 504 loan is actually not one loan, but it's actually two loans. One portion is conventional. That's a loan that is written by a bank or financial institution. And the other portion is SBA. Now, if you were to break up an SBA 504 loan into its components, it would start off with your down. Okay, your down in an SBA 504 for a car wash, a startup, is going to be 20%. And that is plus working capital and plus inventory. So working capital and inventory are not included. So that would be a question. What's not included? Well, working capital and inventory aren't included in an SBA 504 loan. So you're responsible for bringing that in plus your 20%. Term on an SBA 504 loan is typically 20 to 25 years. Right now, we see most are at 25 years. As I mentioned, there are two loans, conventional and SBA. The advantage of the SBA 504 loan is that the SBA portion is fixed for 25 years. The current rate on an SBA 504 loan, the SBA portion of an SBA 504 loan is 2.88%. So that's artificially low. Conventional loan, you're probably looking at around 5%. So if you blend those rates together, you're looking at 4% average rate, amortized over 25 years. So the SBA 504 loan is a very good loan. There are challenges though, because there are multiple loans, you have separate underwritings you have to deal with. And also, one other thing that's not included in an SBA 504 loan is the actual construction loan. So if your lender doesn't include the construction loan, you'll have to go out and get a separate construction lender, which there's costs associated with it. In our 504 loans, though, we do include the construction portion as well as the takeout. The SBA 504 loan, the rates are set after construction's complete. So as I said, current rates blended around 4%. I'm going to move on and talk a little bit about the conventional loans and USDA loans. Now, differentiating conventional from USDA or from SBA, why is a conventional loan different? A conventional loan doesn't have a government guarantee. So conventional loan is only relying on the individuals that are involved and the assets being financed. So typically in a conventional loan, you're going to have a lower loan to value. You're going to be, instead of being at, for example, up to 90% in a 7A or up to 80% in a 504, you're going to be somewhere in the 50 to 70% range. Right now we're doing loans conventionally at about 65% loan to value for startups. Rates and terms can vary. Most of the time we're at a 25-year term on our conventionals, but most conventional loans are 15-year term. So each conventional loan is negotiated individually. The advantage of doing conventional is generally there's a little bit lower fee. The fees related to an SBA loan are typically about 2.75%. On a conventional loan, you're only at about 1%. So you have higher fees with an SBA, you have lower fees with a conventional, but you also have a lower loan to value. And so when you're looking at conventional lending, you have to say, okay, well, I like that because, I probably get a fixed rate. I might be able to get a longer term, but you're also putting in a lot more. And for those of you that are looking at building multiple sites, if you're putting in 40%, for example, in a conventional loan, really that's taking away the opportunity to build your second site. If you were doing 20% down, you would be able to do 2 loans under the SBA, so 2 sites versus 1 under a conventional. So there are some disadvantages to doing a conventional loan. Another loan I'd like to talk about is the USDA. The United States Department of Agriculture actually provides a business and industry loan And it's very similar to the SBA 7A loan. It's for rural sites, populations less than 50,000. The advantage of the USDA is really that it has a 30-year term. So if you go with a longer term, your payments are lower. Rates are very similar to the SBA 7A. Pricing very similar to that. It does require under the USDA B&I loan, you are required to put 20% down. So SBA has lower down than USDA. SBA 504 has better rates. USDA has a longer term, and conventional has lower fees. So there's a mix, and what's right for you is really up to you. I'm available for questions. If you would like to call me, you can reach me at 800-400-0365 or send me an email at mikef@coastcc.com. Thank you very much, and happy washing.
Welcome back to Sonny's, the Car Wash Factory, Virtual Car Wash Expo. I'm Bob Fox from Sonny's Car Wash College in Tamarack, Florida. Joining me on the panel to discuss how to get your project financed is Robert Andre, the General Manager of Car Wash Services of the Southeast of Atlanta, Georgia, and Mike Ford, who is our resident financial guru and probably one of the busiest guys right now that I know with all that's happening in the world of finance. Mike, welcome back. Always good to see you. Thanks for joining us again. Any updates that you want to share with us about anything on the SBA side or money side in general?
Yeah, probably. I think the first thing that since the presentation was filmed was that the SBA came out with a program for payment deferral. Okay, so now people are saying, well, wait a minute, how does that apply to us? We're new investors. If you're a new investor and you get a loan between now and September 27th, the federal government is going to make your payments for the first 6 months. So that's part of the CARES package. So that would be a big change and somewhat of a motivation. So those people that are early in the process, that may not affect, but those people that are moving down the road and closer to getting permits, certainly that can impact you, because that's a significant amount of money to save.
Excuse me, the government's going to make the payments, or they're deferring the payments to the end of the loan?
They're going to make the payments.
They're going to make the payments for 6 months.
For 6 months. Yeah.
Wow. Right. So let me ask you this: what is the average car wash loan? So say an 80-20 loan on a $4 million project. Is all of that going to be, that interest and principal is all going to be paid?
Yeah, that's the good question. That's a very good question, because really it's what is due up front. And is it an interest-only loan initially, or are you doing an acquisition, say an acquisition remodel? So what's principal at the beginning of the loan? Because you're going to get a loan. For example, you may acquire a site for $3 million, and you're putting in $1 million worth of equipment. Well, that $3 million that is money that's been dispersed at that point in time, the principal and interest that's involved with that portion of the loan should be part of this. It's still unclear. So the news is coming out every day, and they're clarifying this. But there is going to be, if you close your loan by September 27th, there's going to be some forgiveness. So that's a big benefit for operators looking to get into the business.
Now, we were talking before we went on the air, and you were saying some of the banks are already out of money. Like I see Wells Fargo said that they're already out. The Secretary of the Treasury, Steve Mnuchin, came on this morning and says, don't worry about it. We're going to put more money in there. So is it like a never-ending supply? Where does this stop?
Well, that comment was in relationship to the payroll protection program. And yeah, so they're gonna, right now, but this is certainly can apply to new operators coming into the business. They may have other business operations. They may not get their payroll protection program plan or loan in time for before it runs out. They're going to replenish that money, but it may take some time.
How long do you think it would take to replace it? I mean, they put it in there pretty quickly.
Yeah, the politicians, I have no idea.
All right, Mike, let's move on to some questions. from the field. For an SBA loan, what percent are the loan fees, and are there any prepayment penalties? This is from Zach.
Okay. Well, it depends on what type of loan you're getting. Right now, if you were to get, for example, a 10-year, if you're just looking to get an equipment loan, any loan that is less than any SBA loan that's less than 15 years in term has no prepayment penalty. The typical loan for a new construction, let's say you're doing a new construction, it's going to be a $4 million loan. Fees for an SBA loan are going to be somewhere in the neighborhood of 2.625%. That's 75% of the guaranteed amount. So there are some fees, but in an SBA loan, for example, an SBA 7A loan, there's other things that are included like working capital and inventory. So even though you're putting in, let's say the 2.625, and you have $100,000 worth of working capital, you're getting that $100,000 back out.
Mm-hmm. That makes sense. All right, Mike. Next question is from Carl. I heard that if you have a current SBA 7A loan, that the SBA is also making those payments for 6 months. Is that so? It says so on the SBA site.
That's right. If you have an SBA 7A loan, they're going to be making the payments for the next 6 months. If you have an SBA 504 loan, they're going to be making the SBA portion of that loan for the next 6 months. So to explain a little bit more about an SBA 504, that's a two-part loan. 40% approximately of the loan proceeds are going to be the SBA loan. The other 60% are conventional loan. So the SBA is paying that 40% for the next 6 months on an SBA 504. On the SBA 7A, it's the full loan payment.
Now, does the borrower have to do anything for this, or it's just automatically going to be done?
It's automatic.
Wow.
Yeah.
That's pretty sweet. All right. Let's see. I heard that's the same question. Harry, an existing owner from yesterday, you said if you close an SBA loan from March 26th to September 27th, you'll get a 6-month P&I deferral. For example, if one closes a loan on 9/1, then the SBA will defer 6 months of payments through February. Question, can you elaborate, please? If you have a new ground up construction, your payments likely will not start until after construction is completed, which can be 6 months or more.
Right. That's the open question that still has to be answered. What we're looking at is what happens. So if you close your loan on September 1st, for example, and what happens at that point in time? Well, you're not funding the full loan. You're funding the purchase of the land. You may fund the deposits on the equipment, and so you might have of that loan maybe $1 million, $1.3 million already dispersed. The question is, and it's still yet to be determined how that's going to be handled. Are they going to make the payments on the full amortized amount of the final loan, or are they going to go off of what has been dispersed at that point in time? And I don't know the answer to that yet.
Okay, fair enough. All right, when purchasing a property, how does a typical investor handle the monthly payment while the wash is going through the city for permits, et cetera? About 1.5 years in California is what they state. What are my options for handling this?
Okay. The first thing that you do if you're purchasing a property, you want to probably try and extend that out so that you don't have to acquire that property while you're going through the permitting process. Some techniques to do that would be to put money down hard. Money down hard means that you get the seller, you say, okay, Mr. and Mrs. Seller, this property is $1 million. I'll give you $100,000 down now, hard, that's non-refundable as we go through the permitting process. And that would be after your due diligence period. So the key factor, first of all, is to get a purchase contract that's out as long as possible. So if you can get a 6-month purchase contract, you're going to be down the road. You're going to know, one, that you should be able to build the wash. You're going to be able to also know that the financing is in place. So you're not putting that money at risk right up front. That's after all of your due diligence is done. Now, if you end up having to purchase that property, yes, typically what we'll see, if you're doing a land-only loan, you're probably going to put 50% down and finance the balance. So yes, and in some cases you can put the interest in the loan. In some cases, you have to make interest only payments during that period.
All right. Robert, I think I'll ask you this question. On average, what are total costs to build and start a car wash?
Oh, um, in a portion of my presentation today that we filmed but we didn't release, we actually go over the financials. I believe we'll be releasing that at a later date. But I would say to build an express car wash today, middle of the road average, you're probably going to be in that $3.5 to $4 million. Biggest varying factor, Bob, is going to be the cost of the land. But if you attended, Brad's presentation and even mine, I talked about the importance of the land, that being a huge key factor. So spending a little bit more on the land to get the right property can be worth it. So I'd say, ballpark for an express today, 3.5 to 4 million on average.
Fair enough. All right, Mike, back to you. With all that's going on right now, do you think it's easier or harder to get an SBA loan?
Well, I mean, right today, yeah, it's harder today simply because all the SBA lending departments are tied up doing this CARES PPP program. But that's going to break loose. The money is going to run out, and then it'll process through, and you should be able to business should be back to normal fairly shortly.
How important is it, Mike, to have a competitive analysis when trying to get financing for my new car wash?
Yes, I think that some of the things that go on at Sonny's with the site analysis that you do are very important. I think that looking at the site and understanding the site is one of the building blocks of a good financing package. Being able to communicate that to your lender and say, hey, here's the demographics of the area. Here's how many people. Here's how many competitors are there. Here's their pricing. Here's how we can compete against them. All of that it can be done through a site analysis where you actually go out and get a feasibility study, or you can rely on professionals like the people at Sonny's who put together site analysis also.
All right, let me go back to online questions here. Mike, how difficult is it to get a car wash financed on a leased property these days?
Leased property. There's a couple of challenges with leased property. The first thing that you have is the fact that there could be an existing loan against that property. So if you look at it from the standpoint of that, it adds the risk of the person that owns that land. If the person that owns that land defaults on the mortgage that they have on that property, then you have a lot of problems. So you have to put in place a number of different things, waivers. In other words, you're going to have to go to the actual property owner, or the mortgage holder, and get them to sign waivers that acknowledge that you have rights to that property. And you also have to do a number of different things like getting assignments so that in the event that there was a default, that the wash could be taken over. So as far as the level of difficulty, it's much more difficult to get a loan on a leased property just simply because of the additional due diligence that has to be made, and also the documentation to protect your position in that property. Because the last thing you want to do is say, okay, the leaseholder of that property, the lessor, is now defaulted, and I'm sorry, from their bank says, I'm sorry, you need to get off our property. So putting the proper documentation in place is critical to doing a loan on a lease site.
A few years ago, most banks wouldn't even consider it, but now things are starting to change, are they not?
Yeah, things have been changing. I think that it is an increased risk, but if you put down enough money on it, and I would say that's in my presentation, we talk about typical SBA 7A down payment of 10 to 20%. Now,
if you're working on a lease site, you're probably going to be looking at somewhere more towards a 20 or even 25% because of the increase in risk, that is.
All right, Mike, I got 1 minute left. We opened approximately a year ago and may have an opportunity for a second location. With regard to obtaining a loan, is 20% an absolute requirement, or can we use some of the equity we have in the existing site?
Well, if you open a year ago, you would not be eligible for a lower. Now, the SBA 504 loan program requires for experienced operators, that's operators with at least 2 years of experience, they will drop that down payment down to 15%. Under the SBA 7A program, you can go in and get a lower down payment, as low as 10%. So yes, you can go down lower. And yes, you may be able to, and I'm not sure what type of loan that individual has, but they may be able to refinance that, roll that in, and combine those two loans and reduce the out of pocket.
Okay, one quick clarification. Someone asked on the loans that the SBA is paying. They're not making the property tax payments, however, right? Just the principal and interest.
I don't think so. I don't know that for sure, though.
I wouldn't think that they would. Mike Ford, always great to see you. Robert Andre, thanks for joining us. You're watching the Virtual Car Wash Expo. You're Sonny's the Car Wash Factory. We'll be back in just a couple of minutes.